Welcome to Think Learn Finance. Today's video is all about the price-to-earnings ratio. By the end of this video you will take away the following. What the price-to-earnings ratio is. How it is calculated. How to use it correctly, and finally, the limitations of P/E ratios. Straight away let's answer, what the hell is a price-to-earnings ratio? A price-to-earnings ratio, or P/E ratio as it is also known, is a financial ratio used to determine the relative value of a company. It is used by investors to help them understand whether a specific company is cheaper in terms of value, compared with its peers, and whether the market expects good future growth from this company. So, how is it calculated? As we can see below, the P/E ratio is made up of two elements. Price per share. This is the current share price on the day that you do the calculation. The price per share is then divided by the second element. The second element is earnings per share, or EPS for short. This is the profit attributable per share, typically for the last 12 months. Or to make things simpler, 1 year's earnings spread equally per share. You do not need to know how to calculate EPS at this stage, just be aware that you are able to obtain this figure from a company's set of accounts, which are available from their website's investor section. The answer of this equals the price-to-earnings ratio. Now we know what a P/E ratio is, and how it is calculated, we now need to discuss, what the hell does it mean? A good way to look at P/E ratios is to treat them as a measure of expectation. For example, a high P/E ratio can indicate a high expectation from shareholders that the company will produce rapid future earnings growth, which is commonly seen with tech companies. However, a low P/E ratio can indicate a low expectation of future earnings growth. But in order to understand whether a P/E ratio is helpful to us as investors, we must first understand what the hell is a good P/E ratio. P/E ratios are dangerous when used on their own. They are a comparison tool and should be used to see how one company compares to other companies within the same sector or market. For example, if a company has a P/E ratio of 15, is this good? Is this too high? Too low perhaps? We need to check what P/E ratios similar companies have, in order to have a frame of reference, before we can make an informed decision. If we look at the table below, we can see that Company A has a P/E ratio of 15. Company B has one of 14. The sector that both companies belong to has an average P/E ratio of 18, and finally, the FTSE 100 has a market average P/E ratio of 20. This shows us that Company A has a higher expectation for future earnings growth compared to Company B. However, when compared with the sector and the market, there are potentially other companies with higher growth potential. This can help us form a decision as to whether we want to purchase Company A over Company B, for instance, or maybe turn our attention elsewhere entirely and look into the wider market for opportunities. So, what the hell are the limitations? While the P/E ratio is a useful tool, as with all ratios in investing, they have their limitations. For instance, it does not take into account any financial leverage a company might have, or the company's growth rate, which we will cover in another video. It is also important to remember that while P/E ratios are a comparison tool, they should not be the only ratio or deciding factor that you use when picking a company to invest into. Therefore, they should be used in conjunction with other financial metrics and analysis techniques so that you can form a more well-rounded and solid foundation on which to base your investing decision on. Before we end this video, let's take a look at a real-world example. We can see the calculation, price per share, so the current share price, divided by the earnings per share, equals the P/E ratio. If we apply this to Tesco plc, the current share price for Tesco is £2.48, or 248.20 and Tesco has an earnings per share of 21.86. We can therefore complete the P/E ratio calculation as follows. £2.48 divided by 21.86 equals a P/E ratio of 11.35. Or in other words, 248.20 divided by 21.86 equals a P/E ratio of 11.35. If you learned something from this episode, please hit that like button and subscribe. Don't forget to check the bell icon to be notified of our new videos. And remember, not everything that shines is gold. Catch you in the next episode.